ICT would argue the market algorithm isn't turned off. It's just news events is just a part of how price is delivered to liquidity targets, not evidence that the algorithm has stopped working.
Well, the market is not run on a giant algorithm. That's an absolute fallacy. Yes, there are execution algorithms, but they're literally there just to execute business. And they do get turned off. 100% they get turned off.
It sounds like he's talking about Banks' algorithm. The algorithm that ICT talks about is the market itself.
That fella there behind me, for a start, and myself, worked in the real world. I know what works because my experience comes from real institutional life, as opposed to somebody, I think, that preaches an institutional approach but never actually worked at an institution.
If there is no kind of algorithm running the market, how is it that intraday traders can predict price levels to the exact tick? All right, folks, here we are on Trading Up. We've got a bit of a different kind of interview for you guys today. We've got two traders in the house who've been on the show. We've got Humble Trader and Paul Scott, where they've got very different styles. We've got ICT and we've got, I suppose, trading floor, what's happened in the past, kind of like stuff happening here on the show. So we're going to go into a bit of a debate session and cover their different styles and see if one stands out to you or not. And you're going to learn something along the way. First off, welcome to the show, guys.
Thank you. Welcome.
Thank you. Welcome. I just want to say real quick, Mr. Paul Scott, I know you don't know me, but I've watched the last few videos you did with Cam, and it's truly an honor to be here to share the stage with you. So I just want you to know that. Thank you for the opportunity.
Yep. Don't be silly. It wasn't up to me. It's up to Cam.
Well, thank you, Cam, and thank you as well. It's just thank you for accepting. This is an honor for sure.
Well, look, I think it's going to be interesting because we've got ICT style, which is, I mean, if people don't know and you're watching this or listening to it and you're thinking, what is this ICT stuff? Basically, it's the whole premise is built around the fact that the market runs on an algorithm. Like, if this happens, then that happens, and it's kind of like a script that plays out on a daily basis. Correct me if I'm wrong, Humble Trader, but that's kind of how I see it at a very high level. And then Paul, he's got a very simplistic style. In fact, there's a video on the channel, you can go and watch it later, which explains exactly what he does. But essentially, he maps out dealing ranges that institutions are effectively looking to buy and sell, and he places trades on the chart based around those levels. Now, the first thing I want to touch on and give you guys, I suppose, a question to start thinking about and giving the guys an answer to is, so and maybe this to you straight away, Humble Trader. So if the market is running on an automated script, why is it that banks, and this is what Paul said in his interview, turn off their trading algos when or before the major news hits? So if it's running on an automated script, why is it that they would potentially do that?
So this is from, obviously I'm a student of ICT, so this is based on what he said. So if the banks pause their bots, it's because of the risk. The risk, obviously, when news comes out, the risk is a lot more when there's a big news event. ICT would argue the market algorithm isn't turned off. It's just news events is just a part of how price is delivered to liquidity targets, not evidence that the algorithm has stopped working. So that's how ICT would explain that.
Okay. And so, Paul, what do you think about that?
Hey, folks, what a view behind me. I'm at Black Bull Markets headquarters here in Auckland, New Zealand. Speaking of views, you can get TradingView paid plans for free at Black Bull Markets, saving you up to $600 a year. That's right. Get either the Essential, Plus, or Premium plans absolutely free. And all you need to do is trade from one lot a month at Black Bull Markets. And you can also get a 100% deposit bonus for your first deposit up to $1,000. All you need to do is click the Trading Nut link in the description below.
Well, the market is not run on a giant algorithm. That's an absolute fallacy. Yes, there are execution algorithms, which we've discussed before, but they're literally there just to execute business. And they do get turned off. 100% they get turned off because they can cause carnage because they can't think for themselves. They're only programmed to do execution. So if a market sort of starts to really drop or really fall, it's going to exacerbate that move, which again is incredibly risky for a bank. So yes, they turn them off because the human mind has the ability to say stop, has the ability to have conversations, has the ability to sort of come to a consensus that, look, we should just all chill out for the minute because we need to, get the human thought process going again. They will get turned back on again, yes, but there is, an example that I would use is my brother-in-law works at JP Morgan, and what his algorithm will do is basically, if the market moves a certain percentage away from its current value, the algorithm will just basically go and hedge for him, so that all of his risk, he's under his risk parameters. But to say that it works on one giant big algorithm is just, it's crazy, because that just does not happen.
And so if we sort of flip the switch on this question and go like, so if the market isn't run by this massive algorithm or this algorithm that sort of plays out every day, how is it that intraday traders can predict price levels to the exact tick and get like super sort of, what we call sniper entries? Humble trader, like, what about you? What are your thoughts on this?
Yeah. So the way we look at it, so Paul says that it's not run on an algorithm, but it sounds like he's talking about Bank's algorithm. The algorithm that ICT talks about is the market itself. It's an algorithm, right? Because if the banks turn off the algorithm, the market's still moving. It doesn't stop moving when they turn the algorithms off. So he's saying the market itself, the whole market, it's an algorithm. So that's why I believe that we are able to predict the way the market to tick the way we do. Sometimes my stop loss is 10, 20 points. It comes closer, but it doesn't touch it, because in my case, if it goes above my stop, it's going to run the opposite direction and go take out some form of liquidity, right? So that's how we're able to predict where the market's going to go, because the way we're taught is algorithmic, right? If there was buying and seller pressure all the time, well, how do you know where to long? How do you know where to short? Like, it's just, I think it'll be unpredictable that way.
Yeah, so if I'm not too sure if you know Paul's approach, but Paul's approach is to literally place 2 pending orders, and whichever gets triggered first after this level's been hit, he's going to take that trade. So he doesn't know whether or not it's going to go long or it's going to go short. He doesn't care. It's just it's a process. So Paul, what about your thoughts on how are these? If there is no kind of algorithm running the market, how is it that the likes of Humble Trader are able to get a small risk, massive reward entry? And I think what are some of those kind of what's your typical average risk to reward, Humble?
I don't really use risk to reward, and I said that last time. I'm targeting, buy, sell, and sell. So liquidity is maybe 1 to 20, 1 to 15, maybe some above that, around that area.
Okay, so Paul's looking at 1 to 2.3 R. So Paul, I mean, how is it that he's able to do this if there's no algorithm running the market? Is my question.
I suppose it'd be how you looked and viewed the market. I mean, it's for me, you can never know if a market is going to go up or if a market's going to go down, and like we've discussed previously, it's a case of just saying, right, I want the market to show its hand before I'm sort of getting in. How somebody would do that without sort of the knowledge of what I do, I wouldn't bullshit you and give you an answer that I couldn't give you. I don't know how he would do it, but I've been doing the same thing for decades. So I don't know. I think it would be the better answer would come from Humble, to be honest.
Because I suppose the question is Humble, have you gone back decades ago to see whether or not this process that you go through still works back then? Now, we talk a lot about strategy and mindset here on the Trading Nut podcast, but that doesn't really matter unless you've got the right environment to trade in. So if you're struggling with a prop firm, then I recommend checking out our partner, propfirmmatch.com. These folks have got a massive database of prop firms, got them all verified there with customer reviews. It's completely impartial and transparent. It's worthwhile checking them out. There's a coupon code and link in the description that's going to help you save some money at checkout too.
Yes. As far as I can go, as far as the chart allows me to go. And yeah, it works. This apparently started whenever the markets went electronic. It used to be regular trading hours. Whenever everything changed to electronic, that's when it all started.
Right. Interesting.
Yeah, like yesterday. So yesterday, my Discord, I called the top of the market, yesterday's high, and I called out the low. I didn't get the very low, but I got pretty close to the low of the market. It went past my low probably for about 300 handles, and then went back the opposite direction. So I missed it by a bit. But again, it's to us, it's just algorithmic. We know where the market's going to stop at, where it's going to reverse at, where it's going to take buy side, where it's going to take sell side.
Okay, interesting. Now we're going to dive into so you guys both previously on the show called a trade, i.e. we looked at the real live market. I went and did the same thing as well, and we tried to each predict a trade, right? And we had Netflix for myself and Paul, and then we had, I think it was NQ for Humbled, yourself and me. Now, what I found really interesting was my one didn't get filled on NQ, and we actually couldn't even match up the price feeds on NQ on TradingView. We tried everything, and I don't know, we couldn't work it out. So you could see a high, and I couldn't see a high, which was just very odd. But anyway, what happened was, and you guys can go back and see this on my TradingView account, is it's all logged there, is that Humbled managed to get a 2-hour trade in about 8 hours. So it was real quick. It did what you said. It closed above this level, came back, would have triggered you in, and then you would have got out at the place you highlighted. Then Paul, we're still in this Netflix trade. It's actually not too far away from the take profit. Your take profit's pretty close, and then you were at 2.33, which is the standard sort of TP for your trade. So really good calls from you guys, and especially Paul for not having traded that market, and even you, Humbled, for not really trading that time frame. You're more on a sort of smaller time frames. My question for both of you is around the length of time for holding trades, and I'm not too sure if either of you trade those time frames. I'm pretty sure you don't. Can you give us sort of a view on the psychology around when you're in a trade and the differences between how long you hold trades for and what other traders, if they were going to take on your style, would need to address within themselves to be able to hold those positions? So maybe, do you want to go first, Paul?
Yeah, so for me, it's not about a specific time frame, because for me, it's trading from a price. So the price is going to be exactly the same as if you look at it on a 1 month, 1 week, 1 day, 1 minute. It's from a particular price. I know that the market has to go through a process, and it's the process of searching for liquidity. It's always about a search for liquidity. And so when you're trading from sort of set prices, you know that it must go from one to the other. When you get to the other price, it's then about, okay, what's the current value by the people that are doing this as a real job? Do they think it's going to respect the same value as it had last time, or will something come along and actually change that value? So if you had sort of something that was expensive, you get back there today, it'll either be expensive again, or something externally would have changed, which means that the price actually breaks and goes up because people don't think it's overvalued anymore. They think it's undervalued. So it is a bit of a longer term approach. But again, that comes down to market volatility. You could have times where the market is particularly volatile, and then with that, you could be in and out on a trade within a day. So for me, it's about, understanding that sometimes things take a bit of time, but the best thing to do is to just get out of the way, let the market go through the process that it must go through. And so I think, if you're used to trading sort of really short-term timeframes, again, you'd have to sort of start thinking about, right, are the guys sitting at investment banks, sort of in and out on trades within, a matter of minutes or, a matter of hours? No, we're position traders. And so we want to sort of have our money in the market as less as possible, but to then take the maximum possible when you have your money exposed.
Okay, and what about you, Humbled? What's your view on the length of time that you're in a trade and the amount of time you have to spend at the charts to make sure that trade is managed?
Yeah, so I agree with Paul about the time frame. Time frame doesn't really matter as far as the charts move the same on every time frame, right? For me, I like the 1 minute chart. The most I like to be in a trade is 30 minutes at most. So usually when I go live, we're done by 10 o'clock. So I start 9:30 open, we're done by 11 o'clock. So usually the trades are 30 minutes long. The for me is more so of having freedom, right? Like I don't want to be stuck to the chart all day and watching a trade. I just want to get in and get out and be done, manage my trade, and then go enjoy the rest of my day. Now, have I taken trades that last not a whole day, but the whole trading session? I have. I don't like to, but I do. But it's more so just time control. You make your money, then you go spend time with your family. That's more important to me than anything else. That's what it is.
And in terms of like I suppose commitment for like others out there trying to think, okay, right, I'm gonna try and do this. What kind of mindset do they need from your point of view, Paul, and would do you Humbled next as well? What kind of mindset do you need to trade your strategy? Like what are the key elements that somebody needs to have?
Patience. Understanding that it is a process and the process must play itself out. And just knowing as well that the methodology within which I teach means you always know where you want to trade from before the market actually even gets to that particular price. So it's not a case of constant analysis at all. It's, set an alert at a price, get the alert, put your orders in, and then see what the market's going to do. I mean, it's at the end of the day, it gives you the ability to trade absolutely anything on the planet that you would wish to. Obviously, some markets move a lot faster and some move a lot slower. But I mean, again, it depends on who you are, which again, what Humbled said is touching upon time. So time spent for me is right, do the chart, mark it up. There's my level. That's my price, set an alert. Boom, I get an alert. Fantastic. I'll go and place trades. If I don't get an alert, I'm not even looking at the screen because the price is obviously not where I want it to be.
And Humble, what about you from a mindset point of view? What kind of attributes does somebody need?
To me, like one of the main things that I preach is patience. You got to have patience, not have FOMO, be ready before market open to anticipate where price is going to go. That's really all I, tell the people. Be ready before market open, at least 5 to 10 minutes. Know where the market's going to run to beforehand. Be patient. Be disciplined with your rules and stick to that, and everything will work out. You'll have your targets. You have your levels. You wait. I give them a full model, a checklist to follow. Those checklists play out, take a trade. And once you win, go enjoy your day.
Okay. So I'm going to dive into a bit more, so I suppose, charting related stuff here. So imagine, you guys both look at retail traders differently, or similar, I suppose quite similar really. So you exploit them differently though. So Paul, you're looking at sort of top and bottom of ranges, whereas Humbled, you actually jump on retail live streams and see what people are doing and kind of do the opposite. So when price does get to like a major level, how do you know if it's going to hold its real value or if the market's just preparing to like sweep and trap everyone? We'll go with you, Humbled, first.
So for me, because we don't look at levels, we're looking at a high and a low, right? When I see the market creates a double top and it pulls back, I'm waiting for the market to go back into an inefficiency. What's an inefficiency? A fair value gap. We'll make it that simple. When the market then pulls back inside a fair value gap, I know it's my turn to enter to attack those double tops for the market to take out those highs, because retail traders are shorting from that area, right? So it gives them, what I call it gives them hope. They're holding for the long term. Then the market pulls back and takes out the high. When it breaks out the high, it's a breaker for them. They go long, then we go short. We go the opposite direction. So that's what we look for.
So, and what about yourself, Paul? I think I know the answer to yours, but you can give it to us.
Well, you don't know. You're not in control of if it's up, if it's down, or what the current value is. So for me, it's about letting the market move first, show its hand, and then get in. So then you can basically say, right, the market has made its mind up about what the current value is, and then therefore I'm just going to go on, hang on to the coattails and take that trade from there.
What I find quite unique between the two of you is that, like, a lot of people will be listening to this and going, oh, I like Paul's method, or oh, I like Humboldt's method. Now, the thing that I find quite unique around you two, and it's a lot of guests that I have on the show anyway, is that there's no swaying you, right? I mean, Humboldt, you're not going to take on Paul's method, and Paul, you're not going to take on Humboldt's. No. So why is it you've got so much conviction in your own method, enough so that you're not going to strategy hop, which is a big issue in for traders as a whole? So Humboldt, what about you?
You got to do what works, right, for you. Strategy hopping never works. I used to do that. It doesn't work. You got to stick to something. Paul's method might work for him and other people. My method is going to work for other people, right? But I believe, and no disrespect to Mr. Paul here, I believe that ICT method is the best method, and there's no other method better than that. It's just because, again, like you see the way the market books. It's, to us, it's algorithmic. It does the same thing over and over. You know what to look for. You know where the market's going to go to beforehand, and you're prepared to execute. It's like a lion waiting to attack a prey. You find the setup, you take it, and you're good.
Paul, yourself?
Yeah. Why would I not go to Board's ICT? That fella there behind me, for a start, and myself, worked in the real world. So we know how it works because we've got real life experience. My old man did that job for a very long time. I also do it for quite a long time. So I know what works because my experience comes from real life, real institutional life, as opposed to somebody, I think, that preaches an institutional approach but never actually worked at an institution. So for me, the one thing that really bugs me about ICT is it says on one of his things that was online that I am your mentor's mentor, which annoyed the hell out of me because that's like, well, that's my first mentor. That's my old man. So it's not him, and it ain't none of the people I ever worked with. So to say that is very, very arrogant without actually ever being at the coalface. So I couldn't change what I do because this is what I was taught. And if it wasn't any good, people at investment banks wouldn't be trading in that way, would they?
It's a valid point. It's a valid point. Now, we're going to dive into the I suppose, the loss aspect of trading. So people do really well when they're winning. Then as soon as they hit a few losing trades in a row, things can spiral out of control. So, Paul, I know you've got like you kind of remove the words "I think" from your trading. So hence why you don't know what's going to happen. You've got no thoughts on it. You just follow the process. Humbled. You force discipline by like cutting your risk and in half. I think if you have a day with or a loss, after a loss during the day, when it goes completely against you guys, I mean, how do you mentally handle losing trades? And what does it do from a emotional point of view so that you don't spiral out of control like a lot of retail traders do? Humbled, we'll go with you first.
Yeah, so for me, losing a trade is inevitable, right? We know that. I know that when I lose a trade, when I win my next trade, I'm going to make what I lost plus some, right? So that's why a trade doesn't affect me. And when I lose, if I use 10 minis, for example, on the NASDAQ, and I lose, well, my next trade, I'm going to cut it to half of that. 5 minis, and when I take that trade and it runs in my direction, I'm gonna make 5 to 10 times more than what I lost. So that's why I'm I lose whatever, I'll get it on the next one. I wait for the setup and then just take it. Now, for me, what I tell my students is when you take a loss, especially new students, when you take a loss, just walk away. That way you don't go on the tilt. Like this morning, the live stream, this lady was up $700 on the day. She's new. and she wanted to take another trade. I was like, just stop for the day. The market's about to get choppy. It's not going to be pretty. And then she was like, okay. So she locked her account. And then 10, 15 minutes later, she's like, oh my God, I'm so happy that I locked it out, because I would have lost this trade and I would have lost this one. The market was just going up and down. I was like, exactly. Just, when you win, you stop. When you lose, just walk away. Tomorrow's a new day. The market's not going anywhere. It's going to be here forever.
Yeah, it is. It is one of the biggest things for people to get their head around. Is that it ain't going away. It's there tomorrow, and walking away is usually the best thing to do. Now, Paul, what about yourself? Like, I know you've got a very simplistic way of getting into trades and out of trades. I mean, what happens when you get a few losers in a row, and how do you keep that mindset on track?
You just have to know that you don't take it personally. If you've won your last 10 trades and then the market comes and it takes 3 trades off of you, you have to be humble enough to say, hey, look, market, you let me have money. At some point, you're going to want some of it back. I can't be annoyed by it. If a market can't make up its mind about what the current value is, then, that's just part and parcel of the game that we play. But yeah, getting up and walking away is something that you can do. But then I always say, look, if you got maybe stopped out at the same level 2 days on the spin, then leave it. Wait for the next level. Don't take that trade again. Don't keep banging your head against the brick wall. But also, it's a job, so you can't be afraid of it. You've got to get back on the horse, essentially. There's got 2 stories. I've got one guy that lost over $1 million in, like we spoke about last time, in maybe 7 seconds. A guy called Gary Casey, and then another guy, Steve Cochran, who walked in the morning at 8 o'clock and said, right, on my positions that I'm holding right now, I'm up $1.3 million. Nobody touch anything. I'm off to play golf. And, he was let off to go and play golf that day because he'd made 1.3 million by 1 minute past 8 in the morning. So we just left it. But it's that the thing is you have to not be afraid to get back on that horse and just accept that trading is a job, and everybody is going to have a bad day at some point, and you just have to pick yourself up from it and not take it personally. And especially if you're trading with money that the market's giving you, be humble enough to accept the fact that at some point it's going to want some of it back.
Yeah, I think the key theme here is probably being humble. We've got a humble trader on as well. So you've mentioned it a couple of times there, Paul. Final question, guys, before we wrap this interview part up and we dive into a chart. So like I speak to a lot of traders, and some of them, not all of them, but some of them tend to think or tend to have the view that they want to continue to improve, i.e. they want to, learn more about the market, about what they can do to tweak their strategy, to improve their strategy. Do either of you two have that mindset where it's like, I want to find out a bit more to get a better result? Or are you very happy in just staying in your lane? You've got to the point now where things either can't be improved, or you just don't want to improve it because it just works. Maybe yourself first, Paul.
Well, I did it as a real job. So I know what works, and, what works for me and what's worked for many people that I've taught over the years. I know what works for the guys at investment banks and hedge funds and the likes, because I worked with them and traded for them. So I wouldn't really want to tweak what I do. I don't see the point, to be perfectly honest. Coming from the real world is a little bit different, I suppose, as a retail trader sort of trying to get in. Yes, you've got to have passion for what you do. Having a greater understanding could only serve you better. But because I was fortunate enough to be born into the business, for me, it's, been there, seen it, done it type thing. And, once you know something, you know something.
What about you, Humbled?
Hey, if candlesticks still confuse you, they're costing you more than you think. My private mentor JJ's decoded 25,000 hours of trading into one better candlestick. Click the link in the description or visit tradingnut.com to watch the free video and grab the free guide.
I'm very happy where I am. I want to improve more. So I'm very like I want to perfect the market to the best of my ability. The other day I took a trade. I trailed my stop. The market went exactly to my target. But before it went to my target, when I trailed my stop, it pulled back and hit my stop. I was kind of upset because I'm like, okay, where did I go wrong with my stop? Things like that I want to improve on, like my target, my stop. Like I just, I kind of want it to be perfect, which is probably going to be impossible. But that's kind of what I'm working on. But as far as the market itself, my strategy, I'm very content. I'm happy. I wouldn't change a thing as far as my strategy.
And what kind of things would you be looking to do or looking at or information you're trying to find out to like fix that stop problem that you've just talked about?
Yeah, just look at, so the market reacts of specific areas. To me, the market is not random. If the market pulls back, let's just say 28,760, why did it pull back there? Why did it stop there? Why did it reverse? And usually when I trail my stop, it never gets hit because I trail it in certain areas where the market shouldn't go past. Because to me, if it goes past that level, now we're going to be bearish, right? If I'm bullish, if we go past that, now we're going to go the opposite direction. So what I look for is what did I miss? What did I miss that the market pulled back and hit my stop? What was it? Did it hit a volume imbalance? Did it hit liquidity void? Did it hit an opening range gap? When you go from electronic hours to regular trading hours, there's a gap. When it hit that? Did it pull back from there? Did it close the gap? Things like that. That knowledge that I have is things that I already know, but maybe I missed it, and just kind of train my eyes to see these things better.
Right. Cool. So it's a training kind of thing versus an information gathering exercise, right, or learning new things. Hey guys, it's been fantastic getting this view from both of you, and hopefully it's given some insight to the listeners out there. Before we dive into these charts, do you want to let us the listeners know how they can find out more about you? So Humbled, maybe you go first.
Yeah, I have a TikTok, a Humble Trader 20. My Discord is the same. My Discord is HumbCap Network. But if you go to my TikTok, you can click the link in my bio and it'll all pop up.
And Paul?
PaulScottFX.com.
Brilliant. What we'll do, folks, is we'll hook those links up in the show notes here. So go down there, find them. Whilst you're down there, hit subscribe, like, and that notifications bell, and we'll see you in the next one where we're going to break down a price chart with these two different approaches.